In this video, I will be talking about the following. We'll first discuss Ralph Nelson Elliott's discovery, and then we'll talk about motive waves, corrective waves, rules, guidelines, wave personalities, Fibonacci relationships, and then I'll have a summary at the end of the key points that I covered. Before getting into the wave principle, let's first look at the man who discovered the wave principle, Ralph Nelson Elliott. An accountant by trade, Ralph Nelson Elliott studied the stock market back in the 1930s. He looked at charts of the Dow Jones Industrial Average on an hourly, daily, weekly, monthly, and yearly basis. And what he found was that crowd behavior, trends and reverses, and certain recognizable patterns that he called waves. He found that these structures link together to form larger versions of the same pattern, and those in turn become the building blocks for patterns of the next larger size, and so on. In 1938, he coined this phenomenon the wave principle. And in 1946, 2 years before his death, he wrote the book Nature's Law, The Secret of the Universe, where he elaborated on his discovery. This is the basic pattern, consists of 5 waves up, numbered 1 through 5, and the way to look at this diagram is to think of time on the x-axis and price on the y-axis. So these are prices that are being plotted over time. We call the first 5 waves up the motive phase. Waves 1, 3, and 5 are actionary waves. They're moving in the direction of the main trend. Waves 2 and 4 are called corrective waves. They interrupt the main trend. After a 5-wave sequence is complete, it is followed by the corrective phase, where we use letters to label the waves A, B, and C. Each wave can further subdivide into other waves, as shown on this chart. We see that waves 1, 3, and 5 in parentheses can subdivide into 5 waves. Waves 2 and 4, the corrective waves, subdivide into 3 waves. And if I carry that a step further, we see other waves further subdividing. Each of these different levels of waves are called degrees, or degrees of observation. In order to communicate our analysis, we assign a name to the various degrees in order to indicate at what time scale we're referring to. Here's a list of the various degrees, and I've highlighted in the center the ones that we use for most of the time: cycle, primary, intermediate, minor, and minute. Let's go back to the main diagram. For the next part of this video, I'm going to focus on the motive phase. Motive waves are 5-wave structures. There's 2 types of motive waves, impulse and diagonal. Within impulse waves, we have extensions and we have truncations. This is a chart of the Dow Jones Industrial Average from the early 1930s to the early 1940s. And if we focus in on this low at 1932, we can see an impulse wave, 5 waves up to 1937. Here's waves 1, 2, 3, 4, and 5. Wave 5 is an extension. In impulse waves, waves 1, 3, and 5 must also subdivide into 5 waves. In an impulse wave, wave 4 can never overlap the price territory of wave 1. You can also see the corrective structure that followed this 5-wave advance, labeled A, B, and C, and we'll talk more about corrective structures later in this video. Extensions may occur in either waves 1, 3, or 5. An extension is defined as an elongated impulse wave, where the subdivisions of the extension are often as large as waves of the next higher degree. Sometimes it's not clear whether the extension is in wave 1, 3, or 5, because the subdivisions of the impulse wave all appear equal. But in any case, there's still a total of 9 waves, as shown in the diagram at the bottom of this chart. Here's an example of an extension in an impulse wave. This is the Dow Jones Industrial Average, monthly data on a log scale from the 1970s to the early 2000s. We have waves 1, 2, 3, and 4 circled. Wave 5 circled is an extension. And you can see that we have an extension within the extension. This wave 3 in parentheses is also an extended wave within wave 5 circled. We also have with impulse waves what we call truncated waves. A truncation occurs where the fifth wave does not terminate beyond the termination point of wave 3, as shown on these diagrams in a bull market example and a bear market example. A truncated wave has the same characteristics as any other impulse wave. It subdivides into 5 waves, but it does not terminate beyond the end of wave 3. Here's an example of a truncated fifth wave in the Swiss stock market index. If we look at this chart from the late 1980s to the early 2000s, here's wave 3 highlighted, wave 4, and here's wave 5, which terminates just short of the termination point of wave 3. The second type of motive wave is called the diagonal. Unlike the impulse wave, waves 1, 3, and 5 in the diagonal subdivide into 3 waves, not 5 waves. And in the diagonal, wave 4 does overlap the price territory of wave 1. The diagonal has a wedge shape, as seen here on this chart, in a bull market, and on the right side, bear market. It is bounded by trend lines that connect the termination points of waves 1 and 3 and waves 2 and 4. The diagonal normally occurs in fifth waves and in the C wave of an ABC zigzag or flat. We'll talk about those structures later in this video. On rare occasions, it will occur in wave 1 or wave A. When the diagonal completed, the next move normally retraces the entire diagonal and possibly more. Here's an example of a diagonal on this chart from 1997 to 2001. And wave 5 circled is a diagonal made up of waves 1, 2, 3, 4, and 5. After the diagonal completed, you can see the next move retrace the entire diagonal. We're now going to move on to the next section, corrective waves, where we'll be focusing on this part right here, these ABC type of structures, or called the corrective phase. The first type of corrective wave we're going to talk about is the zigzag. It's made up of 3 waves, A, B, and C. Wave A is composed of 5 waves, wave B 3 waves, and wave C is composed of 5 waves. Here's an example of a zigzag in coffee futures in 2005, and you can see the ABC zigzag and wave A made up of 5 waves, wave B made up of 3, and wave C made up of 5 waves. The next type of corrective structure is called the flat. In a flat, wave A is made up of 3 waves, wave B 3 waves, and wave C 5 waves. There are 3 types of flats: regular flat, expanded flat, and running flat. And in this example of soybean oil, I wanted to discuss the 3 different types of flats. You see 2 of them here. In the upper left corner, you see a regular flat. In a regular flat, the B wave terminates at about the origin of wave A, and the C wave terminates at about the termination point of wave A. In the expanded flat, wave B goes beyond the origin of wave A, and wave C terminates beyond the termination point of wave A. A running flat looks just like an expanded flat, except that wave C would not terminate beyond the termination point of wave A. The next type of corrective structure is called the triangle. A triangle is made up of waves A, B, C, D, and E. Each wave is normally a zigzag, although sometimes, most often, wave C will be more complex, maybe a double zigzag or triple zigzag. And we'll talk about those combinations later. And here's an example. This is gold futures. It's a weekly chart from 2001 to 2004. And you see this triangle structure in wave 4. Combinations involve any of the other 3 corrective structures, flat, triangle, or zigzag, and they're linked by what we call a next wave, which is a 3-wave structure, as shown here on this chart. Here's an example of a combination in coffee futures. We have an ABC zigzag followed by an X wave, followed by another ABC zigzag. I now want to talk about aspects of the wave principle that involve both motive waves and corrective waves. We'll be talking about rules, guidelines, and wave personalities. There are only 3 rules, and they apply in the context of impulse waves. Wave 2 always retraces less than 100% of wave 1. Wave 3 is never the shortest of waves 1, 3, and 5. And wave 4 does not overlap the price territory of wave 1. Let's now talk about guidelines. The guideline of equality states that of waves 1, 3, and 5, 2 of the waves tend toward equality in terms of price, length, and time. This is especially true if one of the waves is extended, as shown in this example in the Russell 2000 index from July 2002 through 2004. Waves 1 and 5 tend toward equality. Wave 3 is extended. The guideline of alternation states that if one of the corrective waves in a 5-wave sequence is sharp, such as wave 2 here, then wave 4 will be sideways, and vice versa. And here's an example of what we mean by the guideline of alternation. This is coffee futures back in 1999. We see a sharp wave 2 pullback over here, and we see a sideways wave 4. This happens to be an expanding triangle, and that's an example of alternation. We also have alternation within corrective waves. If wave A of correction is sideways, then wave B will tend to be a sharp zigzag, and vice versa. And here's an example of that in cotton futures. We have wave A, which is a flat, expanded flat, followed by a wave B zigzag. The guideline of depth states that in corrective structures, primarily wave 4, that wave 4 will terminate in the area of the previous 4th wave at 1 lesser degree. And here's an example of the guideline of depth. This is the Japanese yen to the US dollar, and we have a 5-wave decline, waves 1, 2, 3, 4, and 5. And here, this ABC, wave 4, terminates in the area of the previous 4th wave at 1 lesser degree. We can use the guideline of channeling to estimate the termination points of waves 4 and 5. You need at least 3 points, waves 1, 2, and 3. And the way you use the channeling technique is you draw a line that connects the termination points of waves 1 and 3, and then we draw a parallel line that includes the termination point of wave 2. That gives us an estimate for where wave 4 will terminate. If we know waves 1, 2, 3, and 4, we can estimate the termination point of wave 5. We do that by drawing a line that includes the termination points of waves 2 and 4, and then we draw a parallel line that includes the termination point of wave 3 to estimate the termination of wave 5. And here's a trend channel in the Dow Jones Industrial Average from the 1970s to the early 2000s. We see waves 1, 2, 3, 4, and 5. We see the lower trend line of the channel connecting waves 2 and 4, and then we see a parallel line that includes the termination point of wave 3 to give us an estimate for the termination point of wave 5. We can also apply the guideline of channeling to zigzags, which are corrective structures. If we connect the origin of wave A with the termination point of wave B, and then draw a parallel line that includes the termination point of wave A, that gives us an estimate for the termination point of wave C. In this example of coffee futures, which we had looked at before, we see that I've drawn a line connecting the origin of wave A with the termination point of wave B, and then a parallel line that includes the termination point of wave A. That gives us an estimate for the termination point of wave C. In this case, wave C terminated slightly below the lower trend line of the channel. Notice also it terminated in the area of the 4th wave at 1 lesser degree, which was our guideline of depth. Within a parallel trend channel, or the converging lines of a diagonal triangle, if a 5th wave approaches the trend line of the channel on declining volume, it's an indication that the wave will meet or fall short of the trend line. If volume is heavy, it indicates a possible penetration of the trend line, which is called a throw-over, or throw-under in a bear market. A throw-over is occasionally signaled
by a preceding throw under either by wave 4 or wave 2 of 5. A throwover is confirmed by an immediate reversal back below the trend line of the channel.
If we go back to our chart of the Dow Jones Industrial Average from the 70s up until the early 2000s, we see an example of throwover. Notice how this fifth wave here terminated above the upper trend line of the channel. The guideline of volume says that volume often is higher in wave 3 than it is in wave 5. If volume is higher in wave 5, that usually means that wave 5 is an extension. The volume in corrective waves such as waves 2 and 4 is normally low. However, one must be careful with volume. You can get spikes in corrective structures as shown here at the termination point of wave A in wave 4 and at the termination point of wave C. Let's talk about wave personality. These waves are not just prices plotted over time. Each wave has its own personality. Let's assume this was over a 5-year period, and we're starting at a major bottom where there's extreme pessimism, possibly a recession or a depression, and economic conditions are very negative. In wave 1, there's a recognition that you're going to survive, that things may improve, so you have an upward movement. In wave 2, the pessimism comes back, and sometimes at the end of wave 2, the pessimism is greater than it was at the beginning of wave 1. Economic conditions can almost be as bad as they were at the beginning of wave 1. But wave 2 doesn't make a new low. When we proceed in wave 3, there's a strong sense of optimism, maybe even some euphoria. The economic conditions improve, and the economic fundamentals become very strong. When we get the correction in wave 4, we experience surprising disappointment. And suddenly, as all this optimism and strong economic growth has come to a halt. In wave 5, the optimism returns, and we also have much larger market participation, but the economic fundamentals are not as good as they were in wave 3. At the time the A wave begins, there's a lot of complacency, and people feel that it's just another correction, that the upward trend is going to continue. So when the B wave moves upward, it fools a lot of people into thinking that the old trend has returned. But the emotional state of the B wave is not as strong as it would be in wave 3 or wave 5. When the C wave occurs, the economic fundamentals turn and become worse, and therefore the change is devastating. I want to talk about the Fibonacci relationships in financial markets and the Fibonacci ratios and multiples. It's sometimes known as the golden ratio, represented by the Greek letter phi, which is 0.618, or its inverse, which is 1.618. We can arrive at the golden ratio of 0.618 by counting consecutively, starting with the number 1 and adding each number to the next. So we have 1 plus 1 is 2, 2 plus 3 is 5, and so on. That produces a series of numbers. When we divide one number by the next number, we get a ratio. And as we move forward in the series, that ratio approaches 0.618. Its inverse is 1.618. These numbers up here, 1, 2, 3, 5, 8, and so on, we refer to those as Fibonacci numbers, and we refer to these numbers 0.618 as Fibonacci ratio or 1.618. Other Fibonacci ratios are 1 minus 0.618, which is 0.382, which you'll see in some of our analysis, or 0.5 and 0.786, which is the square root of 0.618. When we look at Fibonacci relationships in financial markets, there are basically two types, retracements and multiples. Here are two common types of retracements. Wave 2 will often retrace 0.618, the length of wave 1. And wave 4 will often retrace 0.382, the length of wave 3. Let's go back to that chart we looked at on the Dow Jones Industrial Average from the 1930s to the 1940s. Remember, we had 5 waves up, 1, 2, 3, 4, and 5, followed by a corrective structure, A, B, and C. And by now, you can see that the B wave was a triangle B wave here, A, B, C, D, and E, correcting this entire advance. Let's look at some Fibonacci relationships on this chart. If we look at first wave 1 and its retracement, wave 2, we see that wave 2 came down to a 0.786 retracement of wave 1. Here I'm looking at wave 3, and we can see here that wave 4 has retraced approximately 0.382 of wave 3. And if we look at the entire 5-wave advance, we find that this ABC corrective structure retraced approximately 0.618 of the entire distance of waves 1 through 5. Other type of Fibonacci relationships are multiples, and by multiples we mean the following. Wave 5 is sometimes related to the net distance traveled of waves 1 through 3 by the Fibonacci ratio of 0.618. Or wave 5 can be related to the net distance traveled of waves 1 through 3 by the Fibonacci ratio of 0.382. Let's summarize the key points that we covered in this video. The wave principle states that markets are patterned. These patterns are similar at all time scales. The basic pattern consists of motive waves, 5-wave structures, moving in the direction of the main trend of one larger degree, followed by corrective waves, 3-wave structures that interrupt the main trend. Wave patterns adhere to certain rules, guidelines, and Fibonacci relationships. If you're interested in learning more about the wave principle, we have a number of resources that you can access. Thanks very much for viewing this video, and I hope you enjoyed it.